one of the things I took from that, and especially now as we get later and later in the cycle, everybody talks about when is the correction going to happen and how bad it is. Well, if you have long-term debt and all the properties we own now have at least 10-year terms on them, except one that we have a bridge loan on right now, we're going to be able to weather any storm. And if we sell it in the next 5 years, that's great. But if we need to hold it for 10 years, or we have one that even has a 20-year term, I'm perfectly fine holding it.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grinzik, and with me as always, John Cohen. John, how are we doing?
Got no complaints. Hanging in there, getting ready to, Thanksgiving's a couple weeks away. And we got the holidays, a couple deals on the table that we're trying to get to the finish line. So strong year, strong end to the year, and we're doing good.
We may have to trademark that, by the way. Got no complaints.
Got no complaints, exactly. But
start making some T-shirts.
I have a ton of complaints. There's a whole long list of those, but
no, for sure. But yeah, no, today's been good. We just recorded the one with Krista, so if you guys listen to that, same day, back to back. So not going to spend too much time going back and forth. Going to dive right into it, but got a really great guest on today. Another owner, a little bit different area of the country, a little bit of a different asset class. So I think it'll be interesting. Maybe, compare apples to oranges a little bit, see what's a little bit different in his world and kind of what's going on today. With that being said, Sam, thanks for joining us.
Thank you for having me, Chris. It's a pleasure and an honor to be on your podcast.
Oh, very nice.
An honor.
Yeah. Haven't gotten that one yet.
There you go.
We must be moving up in the world. We must be doing something right.
Maybe that's just the Southern charm.
Maybe.
Hey, that works.
Good old Southern boy. But awesome. No, I think we'll have to move down south. I'll feel like royalty. But yeah, why don't you kick it off a little bit? Tell people who you are, what you're about, a little bit about your real estate background, journey, experience, and what you got going on today.
Yeah, I'm a partner with two other guys in a multifamily development and acquisition company. I started off with a background in finance. I got an undergraduate in finance, and then I did an MBA in personal financial planning, master's. And I thought I was going to go the financial planning route. When I graduated, the markets had tanked. I had already had my 766, but I didn't feel like I could advise clients to put in money into a market that I had no control over. So I went to the consulting route for businesses and did tax consulting for 5 years and worked at an energy company for 5 years doing kind of the same thing, business optimization, reducing expenses from a sales tax, property tax, and fuel tax perspective. And during that time, I was honestly miserable, and I knew that wasn't going to be a long-term career. So I wanted to find something that I could gravitate and pivot towards. And I'd always had an interest in real estate. I almost got my master's in real estate. So I decided to start investing in 2009. And granted, that was perfect timing. But I was a limited partner in the first real estate deal I ever did. It was a 208 unit value add, definitely C/D class property in Dallas. It didn't go as smoothly as planned. So after that, I decided to start investing in single family homes. So from 2010 to 2014, I invested in 18 single family homes. That was buy and hold, flip, a spec build, just kind of different things. And then in 2014, I knew I couldn't scale that business like I wanted to. So I started looking at smaller multifamily units for myself. I ran into who's one of my partners now. We used to work together, so we already had a rapport and a relationship. So we started looking for multifamily homes in 2014, 2015, and we just couldn't find a deal. So we brought in our third partner who has been in construction for 20 years. In 2016, and that's kind of what started us on this path. Our first development was mixed use, a 6-unit apartment complex and then 10,000 square feet of retail space. And the project went really well. And it's just led to 10 other projects over the last 3 years.
Awesome.
Yeah. I think it's funny. So I didn't realize quite your whole story, because we're in the mastermind here and there that we do. I think that's so interesting. I never heard somebody that invested in a multifamily deal and then actually went the opposite direction and went back to single family.
Yeah.
If you don't mind, just spend like 2-3 minutes on that like experience and, what made you go back to single family, start doing it yourself. And then also, did any of that play into your decision on like going back into multifamily? Did it affect it at all, or just speak to that a little bit?
Yeah, I can definitely share. I don't think it affected my decision to go back into multifamily. Why I decided to move away from multifamily in the first place is I partnered up with a guy who'd been in the business for about 20 years, so he had a long-term track record.
Mm-hmm.
And we bought in an area that is usually, well, it has pockets that aren't that great, but it's a more affluent area in Dallas. And unfortunately, one of the pockets we invested in was the lower end area, and we had gang violence, we had shootings at the property. He was trying to self-manage initially, and it was a little over his head. So he fired himself. He brought in a third party. They tried to turn it around. They couldn't really do it in at least the time frame we needed. So we kicked him out as the GP, brought in another third party manager, and then one of the limited partners, he had experience. He had an MBA from Stanford or Northwestern and undergrad, vice versa. He had worked in business for quite a while. And then the CFO of the company, the guy that was initially the GP, he stepped up to be, I guess, one of the GPs, and they were able to turn it around. And we were still able to get about 8% annualized return over a 3-year period. But when we bought it to where we sold it, we should have done significantly better.
Sure.
The quick question: 2009 was that purchase, right?
Yeah, it was either late 2009 or 2010.
Okay, because the question I was going to ask, because I know that's like financial crisis, right? The housing markets fall into the grounds.
Yeah.
Now, so if it was later in 2009, it was probably after that period. Do you think that had anything to do with it? Because I don't know what market it was in, but
Dallas, right?
That deal was in Dallas. Okay.
Dallas.
So, but did that have, hindsight's 2020, but when you're looking back at that now, it's like, maybe you spoke about the part of town might not have been the best, but how did that affect it in a way where maybe if the housing market didn't crash, or do you think it would have worked better? Or do you think that maybe the timing and the location, it sort of just was, doomed given all of that?
The market had already crashed, but there was some factors and ramifications from it. There was a couple developments that were supposed to go in right around that area that honestly they're still being developed or weren't finalized until a year or two ago. So that could have played a factor in it. We bought the asset for, I think, roughly $13,000 a door. And now, yeah. And now in that same—
the good old days.
Yeah, and that same submarket is trading for over 100 probably right now.
That was gonna be my next question, is like, how is that area?
Yeah, I mean, it's turned out, it's done well, and within even a mile of it, you'll have $400,000, $500,000, $600,000 homes. So it's a great area. There's just certain pockets where there's apartments that I wouldn't want to live in. I wouldn't mind owning there, but hindsight, we just didn't quite understand how bad the demographic was. And at that time, the economy probably played some sort of a factor, but I think it was more of a management play, because when we got in the second, third party, the property just did phenomenally well. The problem was, like you mentioned, in that time frame, debt wasn't as easy to get as what it is now, and our bridge loan had run its course, and we were having to go to long-term agency debt. And the initial guarantor, GP, since he was removed from the project, he didn't want to sign on any new loans, so we had to sell at that time.
That was. I'm glad you brought that up. I'm pretty sure you've probably had that question asked a bunch of times.
Yes.
But we've discussed it before. Is like the long-term sustainability of it. You look at it now. That you said that property is probably worth 100 a door plus, or give or take, right?
Right. Correct.
Yeah, I mean that's the impact of commercial real estate investing
and going long.
Yeah.
If you can afford it. Yesterday I was speaking at a conference, and someone asked me how'd you get started? And I said, I actually, I own, I bought 150 properties in Pennsylvania, tax deeds. I said, I sold them all. Now looking back, should have owned them, should have held them, but can't always, looking back, who knows what would have happened. It just, deals run their course, and it's hard to course correct when you have a GP that's got no involvement whatsoever. Oh, by the way, sign this loan or someone's got to buy them out. And, 3 years after 2009, 2012, good luck on the debt, right? Yeah. It was, my first deal I did, I had a full recourse 5.25 bridge loan. It was full recourse. And that was 2014. So not too far after that. And, hindsight, you can't change that part of the world, right? The debt world's the debt world, but experience, you're still, you walk away with 8%. Listen to the last podcast with Krista. Yeah, we just spoke about, it was, we back to back where people talk about, some of the war stories, but that war story, you get out with 8%, you didn't lose anything. The bank didn't take the property back. So, it's a loss, but I'm sure it helped your next and future, even the single family home, you probably learned a ton from just that one purchase. And I think that, as Chris was saying earlier, the decision to go multifamily, single family, back to multi, whatever it is, who knows why, but I bet that was a learning experience in itself. And you walk away with 8%, you got to learn, and there's not many people in 2009 that did that. I would say most people probably 2007 and 2009 got smoked because they were not educated and they did some really dumb stuff. But, you got the benefit of really learning, and, the world crumbled and you got to make a couple bucks. So as much as wish I would have held it 10 years later, that's not a realistic scenario.
Yeah, you're exactly right. There's a lot of lessons that I was able to take, and it obviously translates into the business now. But even in single family, you can take some of the principles and it corresponds well. And one of the things I took from that, and especially now as we get later and later in the cycle, everybody talks about when is the correction going to happen and how bad it is. Well, if you have long-term debt and all the properties we own now have at least 10-year terms on them, except one that we have a bridge loan on right now, we're going to be able to weather any storm. And if we sell it in the next 5 years, that's great. But if we need to hold it for 10 years, or we have one that even has a 20-year term, I'm perfectly fine holding it.
You've got to deal with a 20-year loan.
Yes. It's actually a Fannie, and it's a unconventional Fannie loan. It's a military housing loan. So the properties, it fluctuates, but it's anywhere from 30 to 50% military. So they wanted we actually assumed the loan, but the previous buyer put it on. And the rate, it's not bad. It's 4.88 when we bought it. That was a great rate. Now I wish it was a little bit lower, but we'll take it.
No, I hear you. I think that's super interesting. So did that experience in any way shape the type of deals you started targeting after that, whether single family or multifamily?
Well, initially it had me target just single family, and I did that simultaneously.
Okay.
I've learned that I'm a control freak, and at that point, I didn't realize that, but I wanted to basically put my financial future in my own hand. Mm-hmm. And even as a limited partner, yes, you have a little bit of say, but a general partner is going to do essentially what he wants to do.
Right.
So, but moving forward into the multifamily, we started, looking at the same asset classes, pretty much the BC class in different areas of DFW. We just couldn't, we were either told we didn't have experience, so nobody's going to sell to us, or we weren't part of an investor group, so they couldn't trust that we'd raise the money. Because at that time I was under 30, my partner's 3 or 4 years younger than me. So we looked like little kids compared to a lot of the guys who had experience and a track record. So we, after banging our head for a few years, we decided to just try to change things up and create a new will.
So I think that what was funny there was I remember starting, not very similar times, more or less. You got in a little bit earlier on the multifamily side, and I started multifamily in my mid 20s. So about 25, 26, and the first deal I did, you had the same challenge as who's going to trust a 26-year-old buyer that's raising money, and you fast forward that 7 years, and you talk about where we're at in the market cycle. Now it seems like every buyer is 25 years old sponsoring a deal. And those are like, yeah, let's give these guys a shot, right? But you were under 30, your partner was younger, and people are like, there's no shot. Dallas, Fort Worth, good luck. You got hard money, you need experience, and you're not going to take you seriously. But now you fast forward that to 2019, and you give anyone a shot. It's, there's so many more people, and sellers are taking the gamble on the 25-year-old where, that would not have been even the thought process in the mind in a market like Dallas. Now, if you're in a tertiary market or a secondary market, maybe, but, Dallas, Fort Worth, you're top, that's a top 25 market, if not top 5. It wouldn't even be considered. Now, if you went back in there today, as long as you're the highest price, someone's going to say, yeah, let's give this guy a shot. So it's just funny how, you see that stuff happening, and then it makes you question, like, where are we in the market cycle, right? No one knows. And I could easily make an argument that we got 10 years left, but, 7 years ago, good luck trying to buy a deal in a top 25 market with, we're going to go raise all the money, A, B, C, or D. It didn't matter, but it's I'm glad you brought it up, because it's funny, because I was in the same position, and, you're looking at markets originally trying to target a market, and you're like, well, I'm never going to be able to buy here because no one's going to take me seriously. Yeah. But it's interesting to hear, because now it's the complete opposite.
Yeah. Was it just from the seller side, or was it also from the debt side as well?
More so on the seller side. And when we started looking, that was in 2014, and at least in Dallas, people were talking about the market had run its course, and they were expecting a correction probably a year or two from 2014. So part of our issue was we were underwriting conservatively, since we'd be raising the majority of the capital, and it was our first time. We wanted to be able to preserve that capital and not lose anything from the
preservation
investors. But yeah, it's funny looking back on it, because like you were saying, they'll let any 25-year-old buy in Dallas. I think there's so many more capital sources. Syndication has become just maybe it's the circles I'm in, but I feel like everybody I know is in syndication at some extent. And last week, for instance, there was a meetup where a guy was talking who's 25, and he's acquired, I think, almost 600 units in less than a year or two, which is just kind of crazy.
Well, that's like, we have a very good lender friend, a guy I would recommend to anyone on the at CBRE. I mean, he's become a really good friend of ours. He's done a ton of loans for us, and he tells us stories. We went out to dinner with him, and he was telling us stories like, there are people that literally call him, and they're like, oh, here's my financials, this deal pencils out, what's a cap rate? I want to borrow $7 million. And he's like, let's take a step back. But, and all walks of life, you give, 65-year-old retired, businesswoman, or to a, 23-year-old, kid that just read a book. It's, now sellers are more willing to give in there, but it's funny. It's come full circle.
Yeah. I think it just shows how much willing capital is out there right now.
Yep.
And I think part of it's also too, just the impact of technology and the internet over the last 5 years.
Yep.
You just think back to, what iPhones were 5 years ago.
Mm-hmm.
Even 5 years ago, getting on the internet was like a big deal. You'd get like a little bit of data, and if you went over, it was like your phone bill tripled. And now it's like, if you don't have unlimited, it's like, what the hell are you doing? And you basically live on it. And I think that's probably impacted to a certain degree the amount of people that are looking to put money out there, because there is a stupid amount of stupid money out there.
Oh, it's scary. Even at the conference yesterday, I have guys walking over to me, and they're telling me like the capital that they have to put out. And I'm like, this is not, why do you have that much that you have to put out? It's just, you question it. Like, what are your real expectations? Because we had a group told us that they wanted 25% returns net investor in top 25 markets on super distressed deals with a minimum equity check between 10 and 30 million. And I looked at them like, where are you finding a super distressed deal in a top 25 market? I mean, I don't know if that even exists.
Yeah.
No matter how many rocks you turn over, you'd have to find something that's just so unique. But would they develop something? That's a super risk in today's market. If that's the route they wanted to go, I can find you a million deals, but it's not something I may want to do.
I don't know. Are people even developing the 25s today?
I mean, like Dallas has a ton of units being delivered.
Yeah,
New York
does. What is the typical investor return appetite for new development?
On new development, it honestly depends. We're doing one development right now that is a 252 unit apartment complex, and that investor IRR is similar to an acquisition. It's it's a little bit higher, but it's probably low 20s. And then some of the developments we're doing on their smaller sizes, we've already completed one. We're doing another 48 and about to start 68. And that IRR to the LP can jump up to 30 to 40.
Oh, wow.
But it's small, so we come in with one investor, and it just streamlines the process. We're out of the city limits, so we don't have to deal with zoning and all the regulations that city requires, which increases costs, increases time, financing costs. So they're a little different animal, but in downtown Dallas or core market of Dallas, you're probably still looking at that 20 to 25% development.
But I think that's what you need to get someone excited in development. If you put a 12 IRR on a development, you're going to, people are going to look at you like I got six heads.
Right. And developments are so much more risky because you don't have that known demand. So you should be getting a lot higher than 12%.
And then on the development side, I can buy into that on the development. But, they're talking about, they want like vacant multifamily. You go find me a vacant deal in Dallas that's a $30 million equity check. That's good luck.
Going to be impossible. Yeah. I
Correct.
feel like all the brokers are sending deals that are second and third generation renovated products. So it's really hard to find much value. Like I looked at a property a few weeks ago, and it's run by Lincoln as a property management company. They take great care of it, and we were probably 15 to 20,000 off per unit on the offer price, just because I don't see how you can extract value from it, and from what brokers are saying, just isn't realistic with what's going to happen, unless the market just keeps trending upwards for the unforeseeable future.
Yeah, that's a bet I'm not willing to take. I tell people, if you're bringing me a third generation deal in the last set, it was bought, they renovated 10 units, they flipped it because they thought the market was, at its peak. Then another guy bought it, and 16 months later, he's flipping it. I'm not buying that deal. I just have no interest in it. It's either got no upside on the management side, or at some point the merry-go-round's going to stop on the renovations, where I'd be more inclined on the development side to do something if I had that appetite for risk. And I think that's something that is super intriguing in the right, at the right basis in the right market, if you want to believe that. But it's tough to find deals in those big markets that are going to, like you said, Lincoln keeps properties in mint condition for the most part. What are you going to do to manage that deal better? Taxes are going to go up. Texas maybe not, because you have, it's a non-disclosure state.
No, that's actually become a really big issue, and especially the large counties in Texas, is they've become really aggressive in their property taxes. So actually the asset we closed on in September, the property tax value doubled from last year.
Yeah.
Luckily, we got under contract after the assessment had already been issued, and the previous owner, he tried and he fought it, then took it to arbitration, but we couldn't get the value reduced because they know it's there. So the property taxes has definitely become a big issue, even though Texas is a non-disclosure state. And I don't know if y'all are seeing this in Florida, but insurance rates in Texas.
Brutal. So I was on a panel yesterday, and one of the questions that was asked was, what are the biggest underwriting pitfalls? Mm-hmm. And everyone was throwing stuff out, and I just sat there and waited, and everyone spoke, and I looked around. I was like, guys, taxes and insurance. I mean, we're in the coastal market, so our insurance is crazy. But the way the insurance world works is that the coastal markets, because there's losses, and it affects the non-coastal markets. And Dallas, coastal, whatever you want to consider, but it's not the Midwest. But all the insurance is a completely changing landscape in this business. You couple that with taxes, and it's almost impossible to raise rents high enough to offset insurance and taxes. So you factor that in, and you look at a deal, and you're like, okay, my taxes are going from 100 to 200. How am I going to increase the income $100,000 on a 200 unit property or 100 unit, whatever it is? How are you going to increase your income to offset that? And it's not just offset it; it's exceed it without being completely crazy on your expectations. And I think that brokers aren't biting on. We get deals. Oh, it's a 6.5 cap T3, tax adjusted to 4 cap, and it's never going to make money. But
not even tax adjusted. Now it's all market expense adjusted.
Yeah, I like that.
It's throwing in 2015 expenses where it's 900 a unit in payroll and 300 a unit in insurance and all this stuff. And I'm just like, that's not really market anymore. I was like, your last 10 deals, payroll has not been less than 1,200 a unit. So I don't know where you think that market is coming from, but that's crazy. There are some companies like the Tikkajan guys. They underwrite very right.
Yes.
Like they don't fuck around at all. They by far have done
the best
stuff. Have you ever heard of the Tikkajan guys out of Indianapolis?
No, I haven't.
So they were a small shop that just got bought by Cushman. Their underwriting is like the best we've ever seen. We actually joked.
We spoke about that at the conference yesterday. We were talking about their pack. Literally, it's a book. You don't even have to go to an Excel formula. You just you flip in it. They have everything detailed out.
Yeah. All you literally have to do is you just have to put the deal under contract and turn around and hand that to investors and say, hey guys, here's what we're doing.
Yeah.
And it's like, all right, like it's crazy the detail they go to, but they do everything. I'm not going to say right because that's, up for discussion.
Let's not give brokers too much credit.
Yeah. But like a lot of their stuff is like actual T12 or like T12 increased by 2% or, and they play around here or there. And there's deals where they'll mark stuff down and stuff like that. But it's not like some stuff where it's just like they just slash expenses because they can, or, they're just throwing out cap rates like it's candy. It's
100%.
They're slightly better. So it's only like 99% of brokerage books you see.
Correct.
Not 100.
Are you only in Dallas?
No, actually, we aren't even in Dallas. We're throughout Texas and essentially tertiary markets. And then we have one property that's a suburb of Memphis, but it's in Mississippi. So it's a little bit higher demographic than the typical Memphis property.
Oh,
is it in Horn Lake by any chance?
Yes, it is.
So it was funny. We looked at a deal in Horn Lake.
Really?
And when we were flying there, I looked at my partner, and I've had this experience over the last 7 years, more than I'd like to admit, but I looked at him and we're driving. I'm like, do you ever think in your life, he's 58, 59 years old, do you ever think in your life you'd be in Horn Lake, Mississippi? Because coming from Long Island, New York, and both, it's a joke now, it's funny, but, we've bought in Jackson, Mississippi, and even as more recent, I was walking through a mobile home park, and I said, what, did I ever think I'd be touring a mobile home park at 30 years old? And the answer is no. I never, you would have told me that, I would have said bullshit. But it's funny. Horn Lake, we like that deal. We looked at that deal probably 3 years ago at this point. But
that was
there's a lot of deals there. But
yeah.
That's the only. You said a suburb of Memphis outside of Mississippi. I had one guess. I took a shot.
Yeah, there's Horn Lake, and then there's the one. What's the one right next to it, just east?
I can't even remember the name of it, but I know what you're talking about.
Yeah.
It's actually a little bit higher quality.
Yeah.
The only reason I decided to push forward with the Horn Lake deal is it was owned by basically a hospitality and hotel owner, and they just had been managing it that way. So we bought it in March, and we've been able to increase rents per unit like $211.
Wow.
And it was built in 2005, so it's a newer asset. It's not run down like some of the CD.
What was the deal we looked at?
So
that was the Waverly.
No, I know that.
It wasn't 2005.
It was.
It was?
It was, yeah. It doesn't matter.
What was the name of it?
it's Weatherstone.
Okay.
I don't think so.
We looked at a deal called Waverly,
Okay.
Waverly.
Was that really built in the 2000s?
I think so.
I'm just so used to never see anything in the 2000s.
Anything that's like way over our head. We're in the 60s, 70s. If we get a deal with an 80s, we're like, fuck, 80s.
So when y'all underwrite a deal in the 60s or 70s, how much do you put towards CapEx or just contingencies for plumbing, electrical?
Ongoing discussion / argument.
That was the third part I brought up about underwriting mistakes. I said the other thing is, we've bought and sold a combined 4,500 units. I said, we haven't, 3 days ago was the first time we've owned a deal longer than 3 years.
Dang.
So I said this the other day. I said, you guys don't really know, a new syndicator comes in. You really have no idea what it actually costs to own a deal for 5 to 10 years. So what do we put under the line? It depends on how big of a renovation we're going in with. That's the diplomatic answer. But if I was really putting CapEx below the line, I think you got to have a 400 or 500 a unit number down there. If you're going 10 years, because in 10 years, 1970s product, you're going to have plumbing, you're going to have roofs, unless they were just redone, and that may tweak it. But deals cost a lot more money to own and hold than a bank's going to give you and or a broker. Everything's $250 for a broker, $250 below the line.
Yeah,
that's never going to work on a 1970s deal. It's impossible unless you're going in and gutting the entire property, maybe. But if you're buying a deal and you're putting in $3,000 a door, you're going to have plumbing issues in the future. You're going to have a roof problem. You're going to, it's just not going to work. But we typically in the first 2 years, because we spend some money, we'll underwrite to like 250 to 350 in the first, actually like 350 to really like 350 in the first 2 years. And then, we're typically the refinancing or selling, and then we'll go, 400, 500, 600 plus after that. Okay. Part of the reason why we have no shot at buying broker deals. Yeah. It's just difficult to get that, through to their head.
That makes sense. And that's been pretty much my methodology for underwriting. We just haven't, our oldest deal is 96. So I've been kind of leery to buy that 60 or 70 year vintage deal, because if you think about it, if it's built in 60, that's what, 60, almost 59 years old, 60 years old. So there's a lot of hair on it that you might not see from the initial underwriting and due diligence.
Yeah, it's funny. A lot of people don't flip it around and say, "Hey, this property is 60 years old."
No, they don't.
Everybody goes, "Oh, it's built in the 1970s." But when you flip it around, you're like, "Oh shit, this is kind of old." Like
something's
you start to get
break.
a little nervous.
No, it does. I I'm probably the one in the office that pushes. I'm the most negative by far. There's hands down. There's no one more negative than me. I would love to go buy 2010, 2012 built product, low leverage. Your expenses are lower. No, but they don't make any. I mean, they make money, but it's hard to sell that to an investor. And I say, what's peace of mind worth? What is peace of mind worth? Because we bought a 1960s deal built in 3 phases, 400 units in Jackson, Mississippi. And the amount of capital problems we had, I was like, oh my, and we budgeted $4.5 million and we spent every penny of it. But every day it was, whoops, got to fix the plumbing line up. This broke. And it was, that's the inevitable beast with those properties. So, a new buyer going in, not understanding that, they're gonna take it on the chin. I would bet my life on it, unless they have an extensive background in construction or operations, or where they know what they can, rob from Peter and pay Paul.
Yeah, I mean that deal a little bit worse than most. So
that deal was
a little skewed.
That deal was dilapidated.
100%. I mean, almost every one of our 70s built stuff, we end up taking one capital item from our upfront thing and moving it to something else because something else happened. So we always have a contingency in there, and we'll almost always end up scrapping one thing for another, or moving it to a CapEx item below that gets realistically just taken out of cash flow is really the way to put it. Nobody wants to say it that way. Say, oh, it goes to our CapEx below the line budget, but no, you're really that's just a placeholder. It's not an actual line item expense. It's just how much are you taking from cash flow a year, and did you properly budget correctly? Did you guess right is basically what it is. But nobody wants to say it that way because it sounds shitty.
Yep. I have a question. And this is something, I'm intimidated when it comes to newer property, because your expense per unit and your expense ratio. Is that, and they're high level, those are just, gut check numbers. I know it's not Bible or, gospel by any means, but is there a number, like if you see, our deals are running between 45 and 55%, even 60% expenses sometimes. the whole 9 yards, CapEx, soup to nuts. And, sometimes you use it per door, but, tax and insurance, you take it out. On the newer vintage stuff, what's your gut check number? Like, I do quick math, income 50%, NOI, this is what it is. What do you guys typically use when you're looking at newer deals?
On the deals we've developed, we can usually operate anywhere from 30 to 35%. So I use that as a good target. On the acquisitions, they're more, it honestly depends on what's happening from month to month, but it can be anywhere from 35 to, I was looking at financials today on a property and it's operating at 53% OPEX number, which I think is a little high, but I try to shoot between that 35 to 45% range.
Fair enough. I think that's something that sometimes you do that on the newer stuff, pending your rents, obviously. And
right.
Your per unit could be like $6-7 grand. And you're like, ugh, but your rents are higher. So it all makes sense. But I know we look at new deals and I throw 50% expense ratios in there and I'm like, okay, they want 30 million and I'm at 14 million. Like we're very far off here, but it's something that I think, I know a lot of listeners, newer product is awesome. And I would, 2 years ago, if you would have asked me, I would have said anyone can do it. Go buy a deal, figure it out, and learn from your mistakes. If I was advising today, I would definitely advise people, don't bite off a 1970s built deal in the Southeast where you're going to have termites and ACs and roofs and wiring and all these issues. I would tell people, take less, preservation of capital, go buy a new construction or go buy a newer deal because I think you mitigate a lot of problems.
I wholeheartedly agree with that. Obviously, there's going to be operational problems and renovations and tenant issues that you deal with all the time, but it's not going to be as prevalent as some of the issues from a renovation standpoint that you're going to deal with, like the termites, and all of our properties except one are brick. So we don't really have to, I take that back. All the acquisitions are brick except one. So you aren't going to have those termites. You aren't going to have different things that will more than likely affect a 1970s property. Yes, termites might get in the interiors, but the likelihood of it happening in a 2005 or 2015 property is pretty low.
I think that's stuff that, that's the other end of the spectrum. Because I know a lot of people we've had on and a lot of guests and a lot of people out there, they're preaching certain types of deals that I think today appear like better deals. But if the market goes sideways, you're going to be left holding the ball a little bit because, the 8 cap on in-place number deals don't exist. And if you do find that, that's not an 8 cap deal. It's probably significantly worse. And if capital becomes an issue, we have a very good friend who was on our podcast who struggled with a deal because of capital, and it was a 1960s built deal. So I think that, people listening, these are the pros, right? Now, they still have the returns, but some of them might be a little bit more secondary and tertiary, so I'm sure the returns are there. And the new construction has its own risk. But on your deals, are you underwriting to any particular, cap rate increasing or, more cash flow driven, longer term? What are the boxes that you like to see as as an owner, as an investor, as the whole kit and caboodle? What do you want to see?
Honestly, it's very deal dependent. I think one of the metrics I have that won't change at all is we require a 15% IRR return to our LPs. Mm-hmm. And then after that, it changes.
Deal by deal.
Whole period will change. Like the deal in Mississippi, we had to do a bridge loan. So I try not to factor in any type of refinance because it just changes the returns. But on that, I know we're going to refinance this year, next year. So I built in a refinance into the equation. Cash on cash, I try to shoot for 8 to 10%, but that's not going to kill the deal. If I can make it up on the sell, I'll do that. Talking about cap rates, I don't really shoot on a cap rate where I can push it from the acquisition, but I will look at like the average market or industry standard in that area. And however many years we plan on holding it, I'll inflate it by 10 basis points each year. So if we hold it for 5 years, I'll increase it by 50 basis points. Okay. I know I don't know if I should say that's being conservative. I've talked to a lot of people the last 6 months, and they're all saying they think cap rates are still going to compress because it's still one of the higher yielding assets that you can buy, all the capital that's coming in, things like that. But I want to just have that cushion if the market corrects, or when it corrects, then cap rates decompress.
And I think in the newer stuff, the 1990s, the 2000, the newer property, that's whether it's conservative or aggressive. I don't think we're the judges, right? I think that any investor that looks like it might be the judge, but I think that on the newer stuff, that would be my least worry as an investor. If someone presented me a newer construction deal, I don't think I'm going to the cap rate to say, oh, well, your cap rate's too aggressive here. Because I do agree. I think that, where we are in the market, I think that debt's still basically free, and, I do think that's going to give shots in the arm when needed. But I think that what I would like I said, a minimum 15 IRR net to investors or deal, whatever it is, that is super important. I think that's a number that if you feel comfortable with the deal, it's a very easy deal to get to the finish line. Mm-hmm. And then anytime you can get anywhere between an 8 and a 10% cash on cash on a newer vintage deal, I think that, people should be happy about that. Yeah. I would.
I think if you're investing in a 2000 or newer built property and you're going 10 years and you're going to balk over what the exit cap is in
Correct.
10 years, you're not the right investor for that deal.
Yeah.
Even if, whether it's a 4 or 7, you're throwing darts at a board realistically, is because it's 10 years. Nobody 10 years ago could have predicted that we would have gone from, 7 caps down to average 5 caps or 5.5 caps. I mean, it's a massive difference. So, we got punched in the teeth on our last deal because it's an 8-year loan assumption. There's 8 years left. And I didn't want to show, I know you have to show a return, but I said, guys, I could put a 6, I could put a 5, I could put a 3 cap on here. I could put a 20 cap on here. That's not what you should be looking at on this deal. Just look at the physical piece of dirt and the basis and, the cash flow, because that's how you have to look at an 8-year deal. You can't look, whether it's a 6 cap, a 5 cap, a 10 cap, I can show the sensitivity to the investors, but I didn't put it on the first book. And I know we spoke about it, and some investors threw a tantrum. They're like, what is this? So there's no return on this. I'm like, I did that on purpose, and we're fully funded. So eat shit. Yeah. When you have people that are looking at 10-year, what are they typically looking at? Do they care about the exit, the cap rate, or is it more, hey, I really believe in this area, this asset, and it's good cash flow, and I think over 10 years we'll do fine?
Yeah, you're correct. I think at least our investors, I don't know if I've had one investor question my underwriting and the cap rate and ask why I've selected that cap rate. They look more at the market and the fundamentals of the market. All the investors we have right now know us in some form or fashion. So I think we have a trust and credibility with them that some other people might not have. Mm-hmm. I want to get to the private equity or family office investing. We just haven't went down that route yet. And when we do, I know there's going to be a lot more questions, but the investors we have, they are looking at the market and see how we like the deal, and they trust us to invest. But like on that Mississippi deal, we had a lot of people say, we won't invest there because it's not Texas. A, B, it's Memphis or like surrounding area of Memphis. And that just, it was honestly hard to fund that. And we had to bring a significant portion of our own capital to take it to the closing line, just because they weren't familiar with that area. Or they're like, I can invest in Dallas or Houston, San Antonio, and I know that's going to do great. Where Horn Lake, Mississippi, that's a coin toss.
Yeah. No. Was it like, had you guys bought anything outside Texas prior to, or no?
No, that's been our only acquisition outside Texas.
Yeah. I think that's really interesting because it goes back to a little bit in our last episode, we were talking with Krista about setting like investor expectations. And I think that plays along into it. Was it a conversation you had with people prior to purchasing? Like, hey, we're looking at a deal in Mississippi, or it was like, oh yeah, like that sounds interesting. Or was it like, hey, we got this deal under contract that's in Horn Lake, and it was like, Horn Lake, what are you guys doing?
Yeah, we could have primed it better than we did. We got the deal under contract and then started talking to investors. And it was actually at this time last year, we were trying to raise the funds over Thanksgiving and Christmas period, and a lot of people were busy or out of town, out of the country, and they just kind of said, we don't want to deal with it right now. So I think if it would have been a different time frame and we might have primed the situation better, we would have had a better response.
Yeah, well, we had 3 investors in the office the other week. It was John was out, so it was just Don and I, and they were talking about like, oh, okay, like, are you guys looking at anything different or new? We were like, well, we've actually been considering going 10-year debt, 65% leveraged, full term interest only, and trying to get cash flow up to 8, 9, 10, 11, 12% on some of these 70s and 80s built stuff. You know, if you can find a 6 cap tax adjusted and you can borrow at mid to high 3s or 4s, whatever the hell it's at now, you probably, you know, with some value add, you'll get up there probably in double digit cash flow. He's like, well, why haven't you done it yet? I was like, because I'm not going to go put a deal under contract that's totally different to what anybody's seen without knowing I have the investors to go do it, because we had already done that to a certain degree with some other stuff. And we bought stuff in other locations similar to what you did. And it was always like a hurdle to get people over. And luckily we've gotten I think every deal to the finish line, but it was like, all right, we saw it, you know, a couple times. Interesting to hear you had the same thing. And now it's like, all right, we feel maybe we've gone too slow. I don't know, or we just haven't found the right deal. But, you know, we were just like, okay, we've got to prime people better for that expectation of what we're going to do, why we're going to do it, and then also kind of just gauge the appetite. So it sounds like, you know, you guys kind of learned the same thing firsthand. So it's just interesting to hear.
And that's one thing as a company we need to get better on. We always find the deal except one time, and then we try to raise funds. And we don't have a social media presence, or we don't market. So maybe that's part of it. But our biggest, I think, hurdle, or our biggest, maybe not hurdle, but just stress moments are raising capital. Mm-hmm. And the one deal that we talked to investors about and that we gave them time to think about was our largest raise, and we did it probably in one of the fastest times we've ever done a raise. So I think it's just things we need to think about and mull over internally.
Well, I think part of it is most of your stuff is early 2000s acquisitions or new development in Texas, correct?
Correct.
So I'm sure people have a certain expectation that, all right, these guys have bought X amount of deals that fit this mold. I can find, if I want to invest in these deals, I can find it with these guys. They have that track record. So when you kind of step outside that box a little bit, where you toe the line, they're like, whoa, what is this? You know, I didn't come to you for this. Because let's be honest, no investor is solely exclusive to one group. Everybody that is got a little bit of cash to go around, they're probably talking to at least one other person.
Oh,
and
yeah.
if they're smart, they're going to diversify across different geographic locations and different type of assets and different debt and, you know, all sorts of different stuff. So they're probably going to you for that. And they're like, you know, this is what I wanted from you. You know, why are you now going to something else? And, you know, good reason or bad reason, it's just that expectation up front. And, you know, I think that expectation setting is so important going into it. And it's, you know, clear example of it.
Expectations are everything. I mean, with investors, with property managers, if you don't have clear expectations, it's just going to muddy the water, and you're going to have negative ramifications in the future.
It's funny. It's actually and it was not planned, whether you believe it or not, audience. But Krista talking the podcast episode before this, when they go live, it's funny how they both sort of play off each other. It's nice because, you know, we ended that one. And, you know, that deal was about setting expectations. We spoke about expectation setting because it's the most important part of a deal. Now we're ending, you know, not ending, but that's where we're at now here. And I think it's just reiterating and pounding home that, you know, if you set expectations, whether this is the criteria deal we look for, this is how we do our reporting, this is those expectations people learn to agree with. And like I said, the biggest raise you did, it was a breeze because it was in that box. And you know, we do it ourselves. You know, we talk about different strategies, and, you know, you have to tease it out there at first. So it's not just a punch in the face when you actually deliver it. I don't think we do as good a job as we can, but I think we do a good job on it. You know, testing new ideas and before we ever launch anything. But it's
probably to a fault.
Yeah, no, absolutely. I think we test things. It's like, wow, that would have really had some traction. We just never executed on it. But, you know, this comes, you know, whether it's C-class multifamily or newer construction and new construction, expectation setting is the key to this business. It's key to raising money. It's a key to brokers. It's a key to deals because things are going to change and everyone knows that. And I think that's what people have to understand, whether it's new construction or new construction more so than ever. I know you could probably speak to, things that change day to day and permits and zoning and laws and municipalities, good luck on municipalities. They change their mind one day and then the next day they're totally different. And you're only trying to do better things for the municipality and they want to make your life a living hell.
Yeah. We actually, on this new development we had the city come back to us and they promised to basically do a road in between two existing roads. And now they've reneged on that and came back and said, we're going to have to pay for it. So that's going to be $400,000. After a traffic study, they almost made us put in a street light and that was going to be over $1 million, which was just completely.
How is a street light an extra $600,000?
I know I had no idea they were that expensive, but,
you need 18 municipal workers to do it when really it's probably the job of 2 of them.
Yeah. Luckily, they came back and said they would pay for that. But I mean, if we would have had to eat that cost, that would have put the project's IRR significantly lower than what we projected, even though it's going to still be a great project. But it's just, with the municipalities and governments, you never know what they're going to do or say in the time frame. I mean, it takes 8, 10, 12 months just to go through all the zoning and permitting processes.
Yeah, it's crazy.
No, it is. Awesome. I think that's a great place to kind of cap it off. Sam, thanks so much for coming on. Where can people learn more about you, get in touch with you, all that fun stuff?
Yeah, you can reach out to me through my email at sam@trinitycapitaltexas.com, or my phone number is 972-855-7654. And I just want to thank y'all again for having me on. It was a blast just talking real estate with you for an hour.
Absolutely. No, thanks for coming on. We'll have everything in the show notes. Do you have a separate email for your deal in Mississippi? You said Trinity Capital, Texas. So
no. So sorry.
It's all good.
Yeah.
Shit joke. It's all right. We have a bunch of them.
That's okay. Could be worse.
Yeah. All right. But no, thanks for coming on. It was awesome. I think people are going to get a ton of stuff from this, and we'll have to do it again sometime.
Awesome.
Sounds great.
Perfect. Thanks.
Later.